Chairman and President, CEO is with us, Kevin Sayer. Kevin, great to have you on the program here. I want to first kind of talk about how your business has gone through this particular health crisis right now. On some degree, I imagine that it has been sort of having a little barricade in terms of the knock-on risk from the changes in hospitals, given you have specific devices, that you might be insulated from this. But at the same time, we also know there's been big changes to the way people have received medical care these last 8 months. So walk me through what's been happening at Dexcom during this crisis.
Well, there's a couple of things you touched on. Let's talk about people receiving health care just normally. Our device, our continuous glucose monitor, sends glucose values directly to a phone for patients and then onto the cloud where that data can be shared with others who take care of them and who watch over them. On top of that, that data can be accumulated, and we have another system whereby that retrospective data can be reviewed by a physician. So we found our system extremely useful during this time period when people aren't going to doctor's offices like they used to, and healthcare providers can have very meaningful discussions with their patients. On the hospital side, it's been a great ride for us. Our technology typically hasn't been used in the hospital, but the FDA did give us the opportunity to go use it there and to put it on patients struggling with diabetes systems or glucose variability in addition to COVID, because those two things together, extremely high glucose and then the respiratory systems, are awful for patients to deal with. And with our system on a patient in the hospital, that data can be transmitted to another room where the caretakers only have to stick somebody's finger, go in the room, they use less PP&E, and there's alerts and alarms with our system. So really it becomes, on the glucose side, we'll go interact with this patient when we know there's something we need to interact with, rather than going in there all the time. So it's had a great outcome for those hospitals that have used it, and it's been really fun for us.
Your last earnings report was in late October. You pushed up the guidance for the year. The street was surprised by the numbers that you reported. It came ahead of the estimates. Your revenue was up 26% on an annual basis. I also see that profit margins that you put out seem to reflect some of this period where your products became even more necessary, and the value proposition seemed to be highlighted given the limited ability for folks to speak with doctors. Do you expect to be able to maintain some of the growth rates you had during the last 6 months going forward?
You know, we have grown over the past 10 years at a compounded annual growth rate of 44%. It's been an amazing growth story over this period of time. We've given guidance through the end of the year of $1.9 billion for the year. We started our guidance for the year at 1.725. So we've had a very good year, and we've grown very strongly. We haven't launched any guidance for next year, but we just had our investor day, and our long-term outlook for 5 years takes our company out to $4 to $4.5 billion in 2025. We're extremely bullish on the technology and its ability to be used in numerous markets over the next several years.
You mentioned the annualized revenue. I mean, I looked through the numbers on here, and I always try to find the weak spots to needle the guests, Kevin, and there's not a lot of openings here, I got to be honest, because it's been so steady, so consistent, both on the earnings front and the revenue. The one thing I do see is over the course of your growth, you've taken out debt. I see about $2 billion in outstanding debt. Correct me if that number is wrong, but walk me through your plan to keep paying that down.
Well, it's a convertible debt instrument, and we still have well over $2 billion in cash. But we found ourselves as a rapidly growing company with no cash resources. We weren't living on the edge, we didn't have any trouble, but we needed financial flexibility to go do things. So for example, we built out a big factory in Mesa, Arizona to manufacture sensor, which we just announced that we're going to build a factory in Malaysia to give us some international experience as well. And as we shift to our products of the future that are just extremely exciting, those are all automated manufacturing lines, and we now have the money to go acquire the capital equipment to do that. And so we use a lot of our cash for capital equipment and expansion, but the cash from our business will give us the opportunity to pay that back, we believe, without any trouble.
Okay, Kevin, what's the priority right now as you've initiated those capital expenditures to continue to build? I know you've also engaged in some partnerships. We've had the folks over at Livongo on the program here many times before. From what I understand, a partnership between data from your side that you have with the team at Livongo, and walk me through what that means as there have been more tech medical devices plays. It seems like those are not competition yet necessarily to you, but more partnerships. Is that something that can stay a happy partnership? Do they need your data?
We believe it can be a very happy partnership. We designed our systems in the very beginning to share data with other providers because we know we can't develop all the software that anybody would want to use. Groups like Livongo, Onduo, WellDoc, even some of the providers. Level 2 for United Health Group was discussed last week, and they're using our sensor data. So you have opportunities where people can interact with our data in an environment that might give them some information that we don't. So we've designed our systems to do that across the board, and we think it can have applications for all of them. The next frontier there would be type 2 diabetes, like Livongo and some of those partners treat.
The last point here in terms of the cash and what you want to do with it, do you find that it's still best applied to the CapEx side, or now that you have established a bit of a moat and you've gone through some of those capital intensive projects, are there plans for greater shareholder friendly activity over the coming year, buybacks, dividends?
We'll analyze that as we go. At our growth rate, I think the most important thing we can do for our shareholders is invest to keep growing and to expand this marketplace. We are not that deep in our type 1 and type 2 insulin intensive core markets yet. We have a type 2 diabetes opportunity that's massive in front of us in health and wellness. We are in this field against giant companies or with giant companies. We'll use our capital right now to grow. If we see that equation changing over time, we'd certainly look at it differently.